Okay, we're back.
Recording in progress.
We got ADM now coming back in. The proverbial squat, or the actual squat. All right, we want to field some more questions, Bob.
Yep. What point do you take a stock completely off your focus list or watch list or on deck?
If it just falls apart to the point where it doesn't look like it's close to meeting the criteria, if it's going to get on my list, it means that it's relatively close. It's something that I want to watch. And that requires a little bit of imagination to see, where I think it's going to be, maybe in a couple of days or a week or so. But if it looks, it's totally broken apart and it's going to need a lot of work, then it would go off. And then, of course, as I rescreen each week and each day, you're going to see those stocks again. They're going to come up if they reset. So, again, the screening, each time you screen, you will be seeing a lot of the same names.
A lot of ticker symbols. I'm going to try to pre-screen them to a certain extent if there's anything really interesting.
Well, any specific questions except just ticker symbols?
That's what I'm going through. A lot of ticker symbols. Let's see.
Yeah.
On 488, somebody was asking if you could share the formula that you use to get that answer.
On page 488.
Yeah.
488. The formula to get the total return answer?
Right.
Simply your average gain. You would take 124 trades, divide it by 2, which would be 62 trades, right? You take half of your trades are profitable, half are losses. Compound 12.5%, 62 times, and compound 6.25% loss. You can do it in any order. It doesn't matter if you did it gain, loss, or all the gains and all the losses. You're going to compound to 96.5%. So just say you had $100,000 and your first trade was up 12.5%, right? So you'd be up, $12,500. You would then, if you had a loss of 6.25%, compound that into that. And again, it doesn't matter the order, but it's just, taking that average gain, that average loss, and compounding it over 124 trades.
You ever take into account holiday or half day, Black Friday, pre-Christmas volume being light for that reason, or how do you interpret that?
Well, yeah, but if it shows up on the chart, on the, in that pivot, there's only a few days that I would say, right before Christmas. But I'm still gonna play the chart the way the chart, where the ball lies. Let's put it that way. So I'm not gonna be too. It's not like I'm not gonna buy it because if it tightens up and one of the days is the day before, a couple of days before Christmas, I'm still gonna buy the stock if it breaks out.
I'm not sure if you can answer this one, but the question is being asked: did you make what percentage of your money did you make from the little guys versus the big guys
What is that? I don't even know what that means.
in the stock market? I guess they're referring to the retail crowd and versus the institutional traders. I'm not sure how else to interpret that.
It's impossible to answer, but
Question being asked: would you be able to use your strategy as an institutional buyer, meaning you're losing the edge of the quickness and nimbleness of being a small, individual trader?
Well, institutions could certainly, if they were to apply this type of risk management thinking relative to the reward side, would definitely improve their results. Could they get triple digit returns year after year, like some of the guys that are like Mark Ritchie and myself, and have that consistency of really high performance? No, it'd be much more difficult. Very few people have done that. Druckenmiller has done like 30% a year, really unbelievable track record averaged about, I think, 30 some odd percent a year. So you will lose some of, and they have to be more diversified too. So that would also pad that return, but they certainly could improve dramatically, because you may think that professionals um, are really good at this, or um, they understand risk and manage it in relation to reward. But most of the money managed at big institutions, outside of diversification, don't have any strategy to manage risk. When I started back in the 90s, when I started advising the big institutions, the big hedge funds, mutual funds, um, I was absolutely blown away at the lack of risk management and the pure, just almost to a criminal level of what goes on at these big companies that are managing money for people. And I realized that when you give money to a mutual fund, you don't get management, you get exposure. There's a big difference. Market goes down, you go down. Market goes up, you go up, and you don't go up a whole lot more than the market usually, occasionally, but then until it decouples, because it just, the way the whole system is set up is just set up for failure. So that's when I said to myself, I'm never giving my money to anybody to manage other than myself, and certainly not giving it to any big institution that has to put it with a large pool of funds, because they just don't have, it's just not set up for them to be able to even manage risk really super effectively. But they don't even have, matter of fact, there was I won't say his name, but someone who was on TV and very popular for many years, came to my office in New York late 90s and was interested in becoming a client of mine. Just had heard that I had Soros and a few of the big guys, and wanted to find out what it was, what it was about, what I was offering. Came to my office, and they were down big, like I don't know, 50 or 60%, huge, gigantic drawdown. One of the reasons why they came to me, and so I said, well, your performance, why is your performance like this? Do you have any risk management? He said, well, first of all, if it wasn't for the internet stocks, we would be up. So that right there, showed me that they went with these bets and, these speculative areas, and didn't have, any sell strategy. So I said, well, let me ask you a question. When you go into a stock, what, if it goes against you, I mean, at what point do you throw in the towel and admit you're wrong? At what percentage decline? Or is there a, some kind of mechanism to manage the downside? And everybody just kind of stared at each other and went dead silent, and no one would say a word. I said, is there any kind of stop loss? They said, no. Just when the fundamentals of the company change, or, our opinion changes of the company. And of course, as we pointed out here, and many examples, that usually that's way too late. So anyway, there's the institutions are really handicapped, but they could improve dramatically. There could be much better money management at the institutional level. And it's not a surprise either that when you go back, when O'Neill in his heyday, when he still has the institutional service, but when he was really heavily involved, and David Ryan was there, and they had a great team, um, and Bill was really involved with everything. Most of the big performing mutual funds, the guys like the Bill Berger I talked about, Berger was an O'Neill customer. Kenny Hebner was running CGM. Those were all O'Neill customers. He was advising, a lot of the better performers.
I'll just add too, Mark, having briefly interacted, not near to the extent you had, that there's no question, whether you're a small retail or a huge institution, there's massive applicability to this strategy from A to Z, that, how you implement it based on your size. But I mean, the stage analysis alone, if institutions would really learn that, they will be able to step aside from stocks that are going to go nowhere potentially for years. And the reality, to Mark's point, is I know this firsthand. Like, most institutional managers do not take a risk first approach. They take an exposure first approach. precisely what Mark was saying. So I think this is massively applicable regardless of your size.
And many of them are buying stage 4 declines. They're looking for that liquidity to and buying and fading the market. And that's why they underperform. One of the reasons why they underperform. But their size is the real reason why they underperform.
Question on the on a stock like Monster today at an all-time high and yet basing all afternoon. If who are the natural sellers there that are holding this stock from continuing, since everyone's at a profit at a new all-time high?
That doesn't
Can
mean
you-
the stock is just going to keep going up. I mean, they're not to mention too, there just could be a lack of, doesn't have to necessarily be a lot of sellers. There could be a lack of buying, but I have no idea who the sellers are. I mean, there's profit takers. There's still people that have profits in the stock. There's people that bought down here that have profits here. There's people that bought it this morning and have profits in it. You know, it's a very dynamic, ebbing and flowing, living creature. You know, the stock market. There's a lot of activity taking place, but it doesn't really matter. I mean, I don't need to know who they are. You just need to know what the footprints of supply and demand look like, and what accumulation looks like versus distribution. So I can't answer that. I don't know who the buyers and sellers
Oops.
are.
Question of when you're taking a starting position, 6.25%, as you showed the example of, versus a normal full-size position, are you using your 1.25% risk on total equity based on also reducing that by a quarter, or would you still take on a trade a maximum of 1.25 of the entire total equity of your total portfolio?
Well, the 1.25 is, that's just that's a number that is irrespective of that. That's a number of optimal exposure where you're getting enough exposure, but you're not getting too little, you're not getting too much, sort of like the Goldilocks number. If you go much more than that, then you run a risk of ruin. So it doesn't matter what the position size is, because you could have a smaller position size, but have a larger stop. Then you would be right back at the same risk of total equity. So that doesn't matter. That's matter of fact, that's the whole point, is that the position size and the stop are related to each other. So by adjusting those, you get to that 1.25%. So regardless of the position size, you have to try to maintain, that type of exposure. Now, of course, when you're taking smaller positions, it's going to be less, might be less than that, but you want to try to get to an optimal exposure. And the real key is not to go much more. When you start taking 5% risk of total equity, you don't need a very big losing streak to cause a serious hole in your account. So that's the real key, is to have that capped, at 2.5%. If you're really good at this and things are working, would be the absolute max of total equity. That's 25% position with a 10% stop, 50% position, 2.5% stop.
Question being asked on your dashboard, although you're seeing Mark's dashboard, but do you have anywhere where it shows your total equity at risk, total risk per position, or individual positions percentage compared to position sizing? Do you have anything that shows, Mark, Ritchie as well, anything that shows those statistics?
I don't, not on the fly here on my dashboard. No, I'm just managing each position individually.
Sorry, Bob. Oh, go ahead, Mark.
Well, it's just the totality of a bunch of what was the saying? I forgot the saying, but getting a big goal is just putting together a bunch of little things and doing them all right. Climbing a mountain is putting each little step together and getting to the next base camp. The way I trade is I make every decision a good risk reward decision. Now, I'm not going to get myself into a heavily invested situation unless I'm already having that traction. So I'm always going to be, if I'm at that heavy risk, like you're saying, and I have big exposure, it's on the backs of success. So there's like by default, there's protection mechanisms in there. So if I buy, MNST here, and this goes up, I mean, you could see well, let me move it over here. Not seeing the whole thing. These are some of the trades that we have open, but now this doesn't reflect all the trades that were stopped out. We have tons of trades that have been stopped out, way more than are working. So, but let's just say, and that's why we're on, little tiny pilot buys and recommending cash right now. But let's just say that's not the case. Let's just say these are the only trades that I've traded. And now I've got a 15% gain, a 9 change, couple flats here. So as I get more aggressive and I raise my exposure, it's on the backs of profits. All right. And now as this IMVT is moving up and maybe goes up 20%, I start backstopping that. By default, I'm automatically backstopping my, my drawdown, my total drawdown. So by tending to each of these positions properly, I'm tending to my whole portfolio properly. All right. If you want to know that information, that's fine, and know where your total exposure is. But again, if you take 4 positions and you put an 8% stop on them, and you position size, you take four positions, 25% positions, and you have an 8% stop. Well, that's what your total drawdown is. The total drawdown is 8%. You got stopped out of all of them, you'd be down 8%.
All right. Question for Abhishek, who is a long-term holder, in addition to trading, but let's see, he has a stock he's up 75% on. The fundamentals all look great, but now broke down below the 50-day moving average. Do you tend to sell some, or how would you manage the position?
Again,
Yeah, okay.
well, you're not even going to give me the stock. I
Yeah,
got to give
that's
you
kinda-
advice and not even be able to see the stock.
I'm not sure how you can do that really quickly, Abhishek, but let's see. Is there a way to see the 52-week high and low other than looking at the chart itself?
I'm sure there's somewhere where it shows that somewhere. I mean, yeah, I don't know. I just look at the chart.
Yeah, Elliot's asking. Oh, that was that question.
Sure, in the newspaper or something. The stock tables.
Do you use any other source for checking earnings besides MarketSmith? I would share with you, based on what we do internally here, MarketSmith is the last place I go to find an earnings announcement date. Usually the company website.
A lot of times we call the company. We actually confirm
the company
and call
website and call the company.
Yeah, we call the company. We have other news feeds. We have Zach's products, briefing.com and things like that. You can subscribe to something like a Benzinga. Many of these services have news feeds and have earnings calendars and so forth.
Yeah, so on that same line, question about anything that you use to track biotech drug trials and things like that. And I think we had that question just recently on Private Access asked a week or so ago. Mark Ritchie, I think you had an answer of some site for biotech drug results, a website that.
Oh, sure. Yeah, let me just double check my link on that real quick, just to make sure I don't. So I use RTT News for that. And then, yeah, it's just rttnews.com. And then if you go, there is a section under the business where it shows FDA calendars. And then there's 2 calendars, drug approvals and clinical trial calendar. Let me be clear, though. Sometimes all those are going to tell you is, generally speaking, a broad range of maybe, when a stock is due to post results. It's not going to usually give you a data point specific. However, if a stock is setting up or I'm trading it, I'll peek at that to know, is there data potentially imminent? Because if there is, that is additional massive headline risk, especially if it's one of these smaller biotechs with no earnings. So it's just something I peek at to know, hey, do these guys have something, in the not too distant future? And normally I've noticed the early releases can be either way, meaning they can be really good or really bad. I've only, I think, got caught in a really bad one maybe one time, and that was with small position. And again, with biotechs and no earnings, you got to position size accordingly.
I don't think the FDA tells the companies even when they're going to have the results. It's that's why everybody's at the mercy of the government as well with some of the approval processes. Let's see.
That ALNY is still leaking off here. Speaking of.
Yeah, outside
Yeah, pretty good,
bearish engulfing now.
pretty good outside day here. So look at this. See again, since we got those violations, here's the first 1, 2, 3. What was it? Let's see, 1, 2, 3, 4 lower lows right here, right? So that's what I say. After the fourth lower low, every lower low after that is more ominous. We go 5, we go 6, little dead cat bounce, just 2 bars. Also, let me see here. I'm going to see if this just works in the opposite. There are not, I don't think there's 3 higher highs ever. So just like I said before, where you could just ride the trend until you get 3 on the upside, you get 3 lower lows. Just the same thing this way. You've gotten, it's all been 2 higher highs, no 3 higher highs. I don't think there's been more than, nope, there's 2, 1, 2, pretty much the whole way. So again, same principle, stocks under distribution now, you can see. And this is on a smaller time frame, of course, but enough to create this outside day here.
Question on PCVX, if that would be an example of what is a pivot reset already or developing.
Yeah, well, it's not really a pivot reset. This is, really just, this came off as like sort of like bottom fishing here within the base. But this is where I was saying this could be turn into one of those Hardaway crossovers where it just goes up here. Maybe another day, 1, 2, 3 days, you're back in new high ground with no pivot set. So that can happen. And again, you can, you want to try it. You can try it here on this pullback buy and start buying it a couple of days ago. But again, you've got to decide where your out is. On this, this is certainly a good, if you're going to try to get on board here, this is definitely one you want to put yourself in a position to be on because it's a power play. And then again, we're just going to go through the same techniques, measure it. What are we down here? So we're only down about 13%. So that's pretty tight. So this is viable. But what I'd like to see is it, tighten up a bit. I would love to see it come up a little bit and then stall out and form a hold on a second. And form a little right side here. That would be great. We can get a little right side development. Oops. Maybe have a little right side and come up there. That would be great. Now you've got that little double bottom. See where you take it out, you shake out the low, you come up, you tighten up, you squeeze out that last bit of supply, and then bang, you come out and you put in the time. So we just have to keep watching that and living with it and see if it can shape up.
Question to Mark Ritchie from Philippe. What are the best advices you would give to an institutional investor?
Well, if he's expounding upon the point I was making before, it's like there's nothing here that's not applicable. The idea that, well, maybe there's one stock an institution, can't put a big position on because it's, maybe smaller cap or something like that. But I mean, take the 95% club. We're showing you, 100+ year factor modeled history of the largest where the biggest winners in the history of the stock market come from. What more do you need? The groups, the technical criteria, and the entry points. You have all of it. Furthermore, the idea of risk management, position by position and thinking risk first. This is precisely how the good institutions, whether it's hedge funds or even good mutual funds, like Mark highlighted some, guys like, in prior cycles that have had good returns, they're still using good risk management. They might not be able to have their drawdowns quite as small as, guys who can be far more nimble like we are, but still they're whipping the pants off their peers competitively speaking, because they're using good risk management. I'm not going to, I'll tout MPA a little bit, but I think every institution should have MPA's risk model. Raise cash immediately when we're on sell. We went on sell within an hour of the high in November last year.
Yeah.
If you just listen to that alone and never got heavily exposed, well, the way we're getting that self signal is by using analyzing the health of the market on a stock basis first. We saw Mark called this thing months ahead of time last year, saying the stocks are breaking down, the action is poor, markets don't survive this type of negative breath all the way into the top, then called the top. And I mean, we've had clients all year saying, well, when are you going to get aggressive again? When are you going to get aggressive? When
But
things
the
change.
the problem is institutions don't go to cash.
No,
So
they can't. Well, some of them can't, but they could be more defensive. I mean, they could do
no,
something.
absolutely, but they don't. That's the problem. They'll raise, a big cash position for a mutual fund might be 5, 6, or 7%. And that's the problem, is that they're so worried about getting behind the curve, and they're not, nimble enough. And again, the one thing that, they do have a disadvantage as far as that they can't do, well, Mark said everything here is applicable. It is, relatively speaking, and some of it absolutely speaking. But one thing that's not applicable is that, and this is your big advantage, is that they cannot just stop out at 5%. They can't set a stop at the day's low and get out within a matter of pennies, or, or 10 or 20 cents. That's not going to happen. So because of that, there's more risk, and they need more reward. And they have to move these big size positions, and that's the big problem. However, they still could improve. I mean, Kathy Wood has bought, something like PATH, or SKLZ. Bring up something. I'll just bring up a weekly anyway. Let me see. Kathy Wood started buying this stock over here, right off the new issue. She was buying it over here, and she's been still buying it. Okay, that's not exactly stopping out at 5%, but she's not stopping out at 10, 20, 30, 40, 50, 60, 70, 80 either. Doubling up and doubling up. It's just borderline criminal. It's absurd. There's zero risk management. There's no strategy here. If you think anybody buying a stock like this all the way down has a strategy, you're out of your mind. Okay, the strategy is hope and pray, and hope that your opinion's right and the market's wrong. Good luck with that.
The irony, of course, is Mark,
Market's never wrong.
Huh? You and I were looking at that same stock on the primary base. It never set up, so we never got it.
I bought it.
Did you buy it? I didn't buy
bought some right out coming out here, but I got right out. Then of course, the famous Upstart. I mean, I bought Upstart up here. Yeah, right near the high. I also got out right here. So now, of course, if it kept going and they delivered on, and the market was, we went into a top in the market. That's first of all. Second of all, in hindsight, because my car company, car dealership that I own uses Upstart, it turned out to be all bullshit, and everything that they promised never was delivered. So it was a lot of smoke and mirrors, and that showed up in the stock. But at the time, everybody knows, I was very positive on this, but I stopped right out of it. I'm wrong. I get in stocks that go down to 0 too all the time. If I went back and you stayed in all the stocks that I bought, you'd have a tin cup in your hand begging for money. It's why I get out of them. You have even Facebook, Meta is down 75%. The biggest GE went down 90 some odd percent. This is one of the biggest companies, most blue chip companies on the face of the planet. And some of these names stayed down for 15, 20 years. There's nothing new about this. This is the same thing that's happened 1970s. Everybody loved Eastman Kodak in the 80s, digital equipment, Avon products. Never sell Avon products. These stocks that went meteoric went down, and some of them went to zero. And Eastman Kodak and Xerox topped in the 1970s. The S&P went on to go 500%, and they took 24 years before they even came back to break even. So again, institutions could do a lot to improve, but they'll never be able to be as fast as you can. And when I say you, even if you're a big stock trader, tens of millions, even if you had $100 million trading account, all right, you're like a speedboat compared to Fidelity, compared to mutual funds and the big hedge funds. And
Ironic.
If you just got to buy 1,000 shares or 10,000 shares, oh man, and you can't beat the market, it's purely because of your strategy, the way you're approaching it. It's not because it's not beatable. You know, you should be able to beat the S&P 500. If you're trading a relatively small account, you should beat the S&P 500 every year.
Ironically, the monster is now moving just after we talked about it. So the supply must have gone out of the way.
It's starting to come out of the space here.
Mhm.
It'd be nice to get a
Question.
good close on it. Good close would be positive here in a weak
One-
market.
Question related to just what you were going over though, Mark. Shatan is mentioning how, or Cheaton perhaps, is mentioning how he owns Square and Airbnb down 70%. Incredibly hard to sell them now that they are in a range bound. Do you think it's still a good time to sell after this training? He'll never get caught in this situation again.
If you think that I'm going to tell you what to do with a stock, that you're down 50, 60, 70%, and then when it turns around and goes back up, you're going to blame me, you're out of your mind. So I didn't tell you to buy it. I'm not going to tell you to sell it. Would I buy it here? Absolutely not. I wouldn't touch it. And I'm just going to tell you this. When I realize I made a mistake, I correct it. End of story. Whether I realize it right away or I realize it 10 days from now or 10 years from now. Once I realize that I made a mistake, I correct the mistake. If you want to compound the mistake and stay with it and hope and pray, that's your choice. I would never be in this situation in the first place. I would never be in this situation. So it would never happen to me. It's impossible to happen to me. I would be out. Once the stock broke, I'd be gone. If it gapped through my stop and went down 50% on the day, I would sell at the next best price. You would never get me in this situation. Never, ever have I been in this situation since I first started in the very first couple of years. And that's why I've never been in that situation. As Lou Manheim said in Wall Street, you look into the abyss, and that's where man finds his character, and that's what keeps you out of the abyss. A lot of wisdom in that statement. I've been in the abyss, and I don't want to go back. So learn from this, get out of the abyss, and move on. But again, here's where the ego comes in. What is the difference? As if you sell this stock, let's just say you bought this stock at 140 and it's now 100. What is the difference? Whether this stock goes back to 140 and goes up 40%, or you buy a new stock and you buy Monster Beverage, and Monster Beverage goes from 100 to 140, or whatever price it is, it goes up 40%. What is the difference? The difference is Monster Beverage looks better, and this one looks like crap. So that's the real difference. The difference is your ego, there is no difference. There's no difference except the fact that you don't want to take the loss. You don't want to admit you're wrong. But guess what? You already have the loss. Just because you sell it doesn't mean that you get the loss. You already have the loss. You can't go down to the local Bentley dealer and buy as much of a car as you could prior to before this loss. And if you sell it, you're in the same position if you buy a new stock. You're hoping and praying that stock goes up. The difference is I'm going to put my money into something that looks healthy and get it out of the sick patient and move it into, I mean, let's say we have a football team and my running back gets injured. Well, what am I going to do? I pull him out and I put a new player in. I don't keep giving the ball to the guy who's got a broken leg. So, but now here's what'll happen. You'll take that advice, you sell it, you go buy a Monster Beverage. Monster goes down and this one goes up. And then you judge the decision based on one event or a couple stocks, when in fact, as Mark said, if you were to play this stock from this point 1,000 times and Monster Beverage from its spot 1,000 times, which one is going to win? What would you bet on? Taking into consideration that this is in a stage 4, and 98% of stocks in stage 2 are the ones that come on to be big winners. You have a 2% probability here, and you have a 98% probability on the other side. Which one do you think is going to come out a winner over time? So with that, what was the other one? And Airbnb, and what was the other one?
Just looking at this too, I mean, look at all the negative volume breaks in there as well.
Square.
Square, yeah. I don't look, these stocks are down. They could have rip your face off rallies. Absolutely. I think that most of these names, these broken leaders, are probably broken for 5 to 10 years. But that doesn't mean that they can't have big rallies. It's certainly possible. I mean, you look at something like even PayPal, I mean, this is
Right.
just, what's that?
Just noting, not that we use, if you flipped it upside down, it would look like a pretty good chart, but
Yeah. Again, you should never be in this situation. That's the answer. The answer is reset your trading life. Okay. Start over and make vow to never ever get in this situation again. And from this point forward, at some point, I mean, what are you going to do? What if these stocks just sit there for the next 5 years and they never come back? You're just going to wait and not make any money and just hope and pray? See, that's not a strategy. You're not, you don't have a strategy now. You're just hoping and praying. You're just pure luck now. Just like it was pure luck to begin with. That's why you're in this situation. May sound crude or mean to point this stuff out, but this is the truth. You have to get away from ever allowing this to happen. This is why we cut our losses. No one wanted to hear about cutting losses for a year. I was heckled and heckled and heckled and heckled on Twitter by 22-year-old kids with $10,000 accounts that thought they knew more than me. All right. So, and now nobody, you don't hear a word from anyone. They're all gone. Everybody's vaporized. The big guys are vaporized. The brokers are vaporized. The Bitcoin people, they're all vaporized. You see? So again, like we talked about before, yeah, you pyramid up and then the stock comes down and then you bring your position sizing down and then things go up and you're getting whipped around. You don't feel like you're getting anywhere, but you're guaranteeing yourself two things. One, to be trading big when you're trading your best, and small and in cash when you're trading your worst. And that is the price to stay out of this and to be in the bull market and make a fortune. That's the big picture. You got to get away from the noise in between. It ain't easy. I'll tell you right now, it's not easy, because this stock market will validate the biggest morons' ideas every day. Every day, this will make the stock market makes a moron feel like a genius. And the thing is, the thing about being a moron is the whole definition of being a moron is you don't know you're a moron. See, that's the problem. So until it's too late. So that's the problem with the market. Every day it will validate. But you got to look beyond that, beyond the noise, the bigger picture, the ultimate, the final result. Distribution. It's all about distribution. What can you do this consistently? Can it stand the test of time? And can you avoid blowing up your risk of ruin?
Ticker symbol PFHD.
PFHD. Yeah. So proposed merger. See right here? This is a nice thing about MarketSmith. I just wish they would allow you to pull this out of the screens, which I've been lobbying for, because we don't want to see these. Proposed merger. So that this is on a proposed merger. I see what you're looking at here. You're looking at this little cheat area forming. Excellent eye for the chart pattern. All right. This is a bank that's under proposed merger. So I would generally stay away from this. But great eye on the chart.
Sherry's
Cheat
asking
right here, and now you're forming had a low cheat here, and now you're forming a cheat.
Sherry's asking about would you suggest only screening from MarketSmith for the 4 categories? That is where you showed historical precedents of super performers coming from, and is there a way to do that on MarketSmith to only screen for those categories?
There absolutely is a way. So you can go in here, and you can simply, or I'll just show you the group stock. So you can go to
cutoff. Your little cutoff.
I'm sorry. Yeah. Well, that doesn't matter. You don't need to see that. I just group stock I have here. Well, let me go here. So you can go right here, industry name, right? It's right here. And then you can decide what industries, either subgroups. This has all these subgroups, the IVD subgroups, and you can screen from them, or you can even go into where's the sector names? Is that in general? sure where the sectors are. But you could also go by sector. Sector, industry and sector. Am I missing something here? Hold on. Oh, it's right here. Broad sectors. And you can also go by broad sectors. So you can just decide which groups you want to screen. And you can put all those groups in there. You want to have the apparel, manufacturers, and you can exclude. You can exclude, if you want to exclude the cyclicals and run your screens with just those in those groups.
I'm not sure if this question is going to make sense, but the question is on ELF.
Elf, yeah. Elf,
that,
that's the beauty company,
Yep.
cosmetics.
Edward bought it on November 1st, got stopped out of it on November 2nd. Then it took off. Using this as an example, how would you have progressively exposed after it broke out? Again,
Well, first of all, okay, so let's bring it up over here so I can use some measurement tools and so forth. So you bought it on this day right here, which is November 1st, and then you got stopped on this day. So let's see, if you bought it even coming out the very high here, you got stopped at about a 5.63 was at the low. So you had a pretty tight stop, I don't know. I don't understand what you're asking though. How would I progressively expose? I mean, you're in the stock and then you got knocked out. So what am I building progression on? You're out of the stock. Can you clarify, Bob? Am I getting something
no,
wrong?
that's kind of part of the
Yeah.
point for Ed.
Yeah,
That would
I don't know how I would progressively expose on something that I'm knocked out of. You took your position the very next day, you're banged out of it.
GTPC. I'm not sure what that is. Ticker symbol's not coming up. All right. Did both marks take any?
I mean, you do realize too that you bought right into earnings, so it was an earnings report right here. So that was, certainly risk going into the trade.
Did either mark take any personality or ability tests in order to see which style fits them best?
I haven't, no, and I don't. I'm not sure that I would agree that there's a certain personality. I'm sure you could find some correlation, but I would be real careful to pigeonhole someone with that. And just like I don't judge people, sometimes you have these kids, they're troubled in school, and I was one of them. I was real tough with school. I hated school, but I did great when I was enjoying something and I was interested in it. I'd get A's, but I just if I wasn't interested in it, I'd get bad grades. But you get these kids that you think is say, oh my God, he's gonna end up dead or in jail. When I had many people say that about me when I was younger, and they turn out that they're geniuses or they're really really bright people, and just they weren't being challenged or some other things. So I don't like to to pigeonhole, and I don't think there's like natural born traders. I don't believe that. I think you
Except
develop.
Mark Ritchie.
Except Mark Ritchie. Yeah, Mark Ritchie.
Oh, that is not true.
Mark Ritchie is the exception.
No, I'm not. I'll add though, given
Mark,
that my dad was a trader. Speaking of academics, I did well in school, but I was by far the poorest in academics of anyone in my immediate family, and I'm the only one who took to trading. So make of that what you will. But
true, but his father's like a super genius, so we gotta look at the relative bar there.
well,
High bar there.
well,
Yeah,
I agreed at Mark's point. Like if there was a way to quantify who ultimately is going to be, good or not at this, I don't think. I think a lot of it has to do as well with your personal commitment, discipline, desire.
yeah. There's great traders are developed; they're not born.
Here's a good question. Perhaps
This isn't like athletics where you're like, there's some guys just can't jump high. You have physical limitations. This is this you don't even have to be super smart to do this. But discipline, is really the differential. is the emotional intelligence. I think if you measure that, you probably see a much more correlation. But go ahead. I'm sorry, Bob.
What are the top 3 key mistakes that you see traders make after they have completed the Master Trader program?
It would be no different than what they did before. You know, they're the same mistakes. The same mistakes are being made through eternity, you know, for eternity, since the beginning of time till the end of time with trading. You know, it's not cutting your losses is the number one. Not religiously cutting your losses, especially because some people, they do cut their losses, but then every now and then they let some stocks get out of hand, and they have that just this one time moment. You know, discipline. So same mistakes are made over and over and over. Fear of missing out, not looking at your results, doing the post analysis, getting to the truth, letting the math work its way, not thinking in probabilities and thinking over 100, 1,000 trades, getting too myopic. The same thing, the same mistakes are made over and over and over.
Do either one of you subscribe to the algo hunting for stops theory? How do you handle, then a good follow-up, how do you handle a widespread stock, maybe on a thinner name that might be $1 or $2 apart at the open, but it does trigger your stop before the volume comes in and it tightens that spread up? Would you trigger your stop
That's
on that
so
scenario?
hypothetical. I don't even understand all that. There's so much complexity to that. Are those two different questions?
Yeah, well, one's a follow-up to the other.
All right, well, do me a favor, ask them one at a time. First of all, I had a hard enough time with one of them. So the first one is algo hunting.
Yeah, I had a few people asking, they hear the algorithms going and targeting these obvious stop loss areas. You
Yeah,
subscribe to that
yeah.
occurring or happening.
No, absolutely. There's no conspiracy. You know, going back to the 87 crash was blamed on program trading. Then later on, it was the SOS bandits. They were the ones causing all the problems. You know, then it was the high frequency traders. It's algos. I mean, there's always a scapegoat that people who can't do well want to blame it on somebody or something or some group. Um, are there algos in there? Yeah, there are algos in there, but that doesn't mean that's not going to change the law of supply and demand, and it might create some noise every now and then, but there's going to be your idea is to look where the noise, you know, look where there's the lack of the noise. That's why you do this analysis, to find out where those low risk entry points are, and you know, this idea that they're out there hunting for you. If that was the case, let's just say that's true. That would mean that they're taking advantage of you. And that means algo trading would be like where all the money's being made. How come there's not this big industry of mutual funds, algo mutual funds that are making big returns? I don't know of them. Do you know any of them, Mark? You know any big firms that are getting these big returns with algos? I don't know any of them. So like, I guess if they're taking advantage of you and there's this big conspiracy, well, they're not making money either. So they ruin it for you, but they can't even benefit from it. It's absurd. It's absurd. It's another excuse. And I
Yeah,
don't know
just
why didn't they take advantage of me last year when I won the U.S. Investing Championship up 343%? I don't know. Algos didn't get a hold of me, and it was in a horrible market where like it was like Algo City. They were just breaking out and then coming back in. Everybody was blaming algos in 2021 because all the breakouts were failing. They were just saying, "Oh, they break out and the algos sell right into it and they suck you in." And well, they didn't win over me. They didn't win over Mark Ritchie. You know, so.
yeah, I just wanted to add the comment on the top 3 mistakes that traders make after the workshop would be not absorbing and digesting all the information that you guys have been learning for the last 5 days and using it religiously with discipline. I mean, that is, again, not a mistake you're not making or have made before coming here, like Mark said. So
The biggest mistake is that you move on, you have style drifts, that because everybody comes to the seminar and they get the workbooks and they go home all excited. Then 3 months later, probably half of the people, the workbooks have dust on them and they're sitting over in a corner and they've never been looked at again. And, in 6 months, 12 months later, if they even tried the strategy, they get it through a period that didn't work well and they're going to another seminar, trying something else. And they never become great at any one thing. You've got to commit. If this has worked for me, it's worked for Mark, it's worked for hundreds and thousands of other traders, then it can work for you too. But again, it's not going to happen overnight. You have to spend the time and commit to it. And I'm not saying you need to commit to my strategy. You need to commit to something, because you have to get the experience and get the skill and master something. If you're jacks of all trades do not get paid really well in the stock market. You need to be a specialist.
INSW
INSW.
being asked if it's a power play. No.
No, not even close. You need to double in 8 weeks or less.
Somebody's asking if you would please ask Mark to analyze the base count for ENPH.
ENPH, base count. Okay, let's look at a weekly, see how far back we go. Let's even go to, actually, I'm going to go here. Go here. And I'll go to a weekly. Go to ENPH. So the way I count bases is when you first get into a stage 2 uptrend, start from there. So I would say that this is your first base right here. Either this base or this base would be your first base. So let's call it here 1, 2, 3. You might have 4. So you might be in your fifth, sixth stage base. Now you do have a big long base here, and you're going through a bear market. Some stocks can hold up, can be a leader in one cycle, hold up, and then lead in the next cycle, but not many. Okay, so I would say that this is looking, it is stage 2 right here, but it is looking, as far as looking at base counts. And again, this is one, when I see something like this, you may want to go back, do that analysis, look at the PE ratio, see how much expansion. If this is, tripled its PE, and so forth, you're going to at least get an indication that you're definitely late stage here. It's clearly late stage, but you did, now there's the theory or concept of reset, where in a bear market, or if you have a real big washout, you start recounting and reset the count. So if you go into, say, a stage 3 into a 4, and then you go back through a 1 into a 2 again, now you're starting all over. Well, this right here is a pretty big long base, which you could make a case where you went from 2 to 1, and now you're back in 2 again, and this is enough to reset it for another good move. And if if it's a really big secular move in cycle, this could keep working. So but it definitely looks late stage. It looks late stage. It looks like it's potentially stage 3. And this reminds me of Tesla. Take a look at Tesla. See, Tesla here, stage 1, stage 2, and now you see, think of ENPH like right here, right? Where now you've sort of moved sideways for a while. And now if this was to reset and maybe break out here, but then start rolling over, but Tesla was more classic stage 3. It morphed into stage 3 and right into stage 4 pretty quickly and more in a classic fashion. ENPH is spending a bit more time here building. I see it tried to do that right here. See, it started to that stage 3 false breakout, comes in, now starts rolling like in stage 4, but now it's resetting. So you can make a case where you reset here, and now this is your first or second stage base. Again, very inexact science. It's going to give you an idea, but you just got to watch and see if it acts right, and the earnings come in, and so forth. A big part of the solar group, and recently, was the election. If the gridlock with the House and Senate being split is actually good for some industries that or at least the thought was that Republicans would not be pro green and solar, and that's what had caused some volatility in the stock here. So we'll see, but so far it's acting pretty good. First Solar is acting pretty good. My cousin is really top guy in the solar industry. He's been in solar forever, like from the very, very beginning. He's on the Al Gore team and the whole thing. One of the most knowledgeable people I know in the world on solar. And he told me that that the Chinese products, even he said even the Canadian solar are Chinese products. And that answers your question, Bob, too, about the solar panels. Bob's getting solar panels, and my cousin is advising him. But so he said that he was having a hard time, that getting product from these companies and that high demand, the Enphase, the First Solar, all these companies. So that's certainly a good tailwind. But I don't know, with supply chain issues and all that, sometimes that high demand that you can't fill the orders and becomes a problem. And it doesn't mean anything that you have the big orders. And again, that's why you got to see how the stock's reacting to the earnings, and so forth. So far, this has acted pretty good in response to the fundamentals.
GFS, I don't remember if we reviewed it, but I do have a few people pinging
GFS,
about that. Yeah. Another solar name, I think, or
Mhm.
maybe semiconductor.
GFS is a semiconductor.
Yeah, semiconductor.
Yeah. Is this a question?
Yeah, if you could review it, Beam Bible.
Well, I mean, again, it's it's a big sideways move. There's no uptrend. I mean, there's absolutely no uptrend at all. So, this just doesn't have the strength. It's a 93. I mean, it's it's holding up pretty well here. Bit volatile. I mean, it's just sort of in no man's land for me. It doesn't really have the trend behind it. So, I think there's better names that look stronger.
All right. On 484, if you want to pull the book up, page 44, there was a question.
That alarm. That's the home stretch. That's the 345 alarm. Let's see. What number?
484.
484.
If you could review the purchase of GPS cap stores. I still can't see why this was a buy. It looks like a lot of chop.
Like a what?
A lot of chop.
A lot of
To-
chop.
yeah.
I don't know how you can say that. This is very tight here. Very nice and tight right here. A perfect base forming. Yeah, real nice tight entry. I'm not sure where you see chop. This is a perfect 1, 2, 3, 4. Absolutely perfect pivot setup. So I don't know where you see chop. I can measure that. I don't know. Is GPS? Hold on a second. Is still GPS, right?
Yeah.
When is that? When is that?
6.
When is that chart? What's the date on that chart?
Yeah. Not really clear. It looks like, let me see if I can
I
pull
can
it up
probably
here.
find it just by looking at the chart here. There it is, right here. See, that's how
2012.
much these stocks are unique. I just go through the chart and right away, bang, spot it. It's right there. It's so easy to spot. So it's right here. So let's take a look at what it looked like at the time. Here's where I'm buying it, right here, coming out right here. So let's measure. That is a 3.4%, 4% pullback. So let's look at the VCP right here. That's 14%. Let's measure these because one would negate the other. This is 6.65. This is 6.81, about the same. So we would even say that that's 2 right over here. And then this is 3 right here. You tell me how a 15% to 6 to 3 in perfect orderly fashion of tightening up, almost perfect halving. You go from 14.7 and 6.81, almost perfect in half. You go from 6.81 to 3.35, almost perfectly in half, and a nice tight pivot here. I don't know where you're talking about chop.
And I would just draw the line there too, Mark. It's a perfect example of a tight pivot there. Draw, do the old David Ryan draw. There's no supply.
No, let's see, yeah. Hold on, yeah, right through here. Nope. There's actually, when it comes through here, there's no supply at all the supply is gone. And your goal is to get on these names, going into a bull market, that or in a bull market. That's your goal. And these could be the big winners. Now this stock went through a correction here, set up another big cup with handle right here, just another big VCP, went on, and there's another one. Now it's getting a bit more sloppy. And then finally you get the big break. There's your big sell rule right there. That's the big break. There's the big volume, largest break, largest volume is probably, yeah, there it goes. See, that told you that the institutions, this is where they're running for the hills. The elephants are running to the keyhole now. And now, you get that dead cat bounce, but now you're morphing, you're in that stage 3. Remember, I told you the way you're in stage 3 is when you start getting these big breaks. You get these big breaks, and now you're flattening out and you're whipping, the volatility picks up. And that's the heads up before you head into the stage 4. Perfect stage 2, 3, 4. And then now, oh wow, see, so this is just still has been all over the place. Look at this volatility, it's all over the place. And look at the difference between your stages. When you're in this stage 2, look at how orderly versus when you're all over the place here and you got this big giant volatility. Anyway, what's any next question?
Christian is making the comment he has worked for $2 billion hedge funds. Neither of them had any concept of risk, at least what is being discussed here at MTP.
Yeah. Oh yeah, it's the biggest of the big. I've advised some of the biggest in the business and was privy to some amazing people. And the ones that did well, one in particular, which I'm not going to throw out a name, but someone who I advised and met with on a regular basis, is a very high profile billionaire now. And I was advising him when he was virtually not a kid, but in his late 20s, early 30s, and barely knew how to read charts, but was worked for one of the biggest hedge funds in the world and became a mogul, but managed that risk in relation to reward. I mean, that was the secret.
Page 49. Quick question. How many of your purchases are using a pullback buy versus a breakout? Mark?
It depends on the environment, but it could be where sometimes our initial buys, because all we're getting are pullback buys, so we get into a handful of names, and then as the market improves and stocks set up and it gets easier, we start buying breakouts. Or a lot of times it's just the opposite, and I'll tell you why. Like I just said, I'm being a real stickler now, so I'm going to want the setups to be perfect, breaking out of those tight pivots. Well, if stocks start working real well and we get into a bull market where it's pretty obvious, we're in a new bull market, then I start anticipating, I start buying the pullback buys, I start widening my or loosening my parameters, still within my loose parameters are almost probably as tight as anybody out there, but relatively speaking, within these confines of my my mandate, if you will, now I start to use those pullback buys. So it could work in either direction, but you cannot say that there's a certain percentage. I'm sure if we went back and looked at it, there obviously there would be a certain percentage, but you can't say that you can rely upon that going forward. And I would say it's not skewed like really heavily in any one direction, like it's 90% pullback buys and only a few breakouts. It's both. It's pretty evenly distributed. I'd probably say more breakouts, a little bit more breakouts than pullback buys myself. Would you have any estimate of your own trading as far as the pullback buys versus the breakouts?
Ideally breakouts, of course, but I would say then.
What's your results of what you actually percentage wise you think?
Yeah, I would guess maybe a quarter of the time, a third of the time or something. But generally I would use the pullback buy to start the position. or something like that versus with the hope of, getting a cheater handle to add. I kind of think of it as pullback buy for me is sometimes I'm trying to cheat on the cheat. It's like I'm trying to get in a small position ahead of the pivot. So
Yes.
that's how I think about it.
Right, which means well, again, so like it'll be a blend and they'll morph into each other. So maybe right now things are not that great, so we'll take small positions from a pullback buy and the cheat, and then okay, now that starts working, and now we get another pivot, and now we add to that position on the breakout, and now more stocks start working, and we get confident, and now we go heavier on the pullback buys because things are working now. And it's just a dynamic thing that. But here's the key. The key is you want to take the setups, the pitches as they come across the plate. You don't want to get good at forecasting what might happen. You want to get good at responding to what is actually happening before your eyes and taking advantage of it. So that's the key. The key is that, look, you're a baseball player, right? You go against a pitcher. Different pitchers have different styles and, throw the ball from different angles at you. Some like a breaking ball, some have a mean fastball, high heat. You've got to adjust for that, and you can't just wait for a different pitcher. This pitcher's pitching in the game. Those are the pitches that are being thrown at you. You got to hit the ball. You have to figure out a way to make contact, of course, but you're not going to swing for a ball that's 3 foot off the plate, right? It still has to be around the plate, but it may be, you like it high outside. You may have to swing at some balls inside, low inside, within that framework of being still over the plate. You don't want to stretch outside. There is a framework that you have to operate within, but inside that framework, you do have some latitude.
All right. I know, guys, there's also a number of questions being typed here by individuals asking about things related to the private access services and such. So I would just ask you, you are seeing a lot of what happens every day, just not in this format. This is the background of what's going on every day, and the result of the work that you're seeing firsthand here is exactly what gets communicated through alerts throughout the day. Of course, it's much more than that, but just send me a quick email to remind me. I'll give you a call because this is not the form that we really want to use for being able to talk about that.
No, but I rarely get a chance to talk about Monalert, which is our newest product and service, and we are working on really making a product that's already great, totally amazing. Which is, for those of you who don't know what Monalert is, it tracks the stock and then gives you a report of the violations and confirmations. So it sort of watches the stock for you, and it helps you not only manage the position and know when a stock's acting right or wrong, but it trains your eye. But we're now we're taking it to a charting level where it's going to be really amazing, and it's going to relate to the charting, and you're going to actually see it overlaid over the charts, and you're able to use it in a whole nother way. We're going to have our own charting program very soon, within a couple months, with the Monalert. So it's something that you should take a peek at, because I'm literally creating a new category that doesn't exist, and it's going to be the most helpful way to analyze a chart that has been developed yet.
Very true, and something that is for many of you here that are private access members are already familiar with that, but it is a game changing, even if you are a private access member and not using it fully yet. It really is a game changing component that Mark created.
You created a new word, fulfilling.
Yeah, fulfilling. Well, there was a question to ask: are the Eagles going to make it to the Super Bowl? So maybe you can give us the answer to that one too.
I'll take the other side of that one.
No,
I will only say this: only three times.
I thought Vikings were going to win last night, so don't ask.
Only 3 times have the Eagles been 9-1 in their career, their history, and all 3 times they made it to the Super Bowl. So that's working for me.
Well, I should say, I thought the Vikings could win if they had their players, but they didn't have all their players. But But anyway, we're at, what time is it? Yeah, oh, so wow, we're at 4 o'clock here. So we are, sadly, we are wrapping this up. Hate to see you go. It's been, a long time here. We put in, 5 days, lots of hours. I'm exhausted. And, I, I'm sure you learned a ton, probably way more than you could retain, but what you should do is go back and reread my books. If you're really serious about taking this and internalizing it, you not only study the workbook and go over your notes, but if you go back and read my books now, they're going to have a whole new meaning. A lot of things in there that you might not have understood or grasped or maybe slipped through the cracks will start to illuminate even more. And as you bounce back between the books and the workbooks, you're going to it's going to help you and reinforce. And then if you come on as a private access, that's something that's a daily, where it also moves you through the learning curve. Um, Mark, I want to thank you for taking all this time and being a great co-host, and Bob, of course, moderating this for the 13th year. It's a lot of work. Um, another great program, a great success, and wish you guys all the best. And I hope it's been everything you expected and much more. We could sit here and talk about this stuff for days and days more, but at some point we are repeating ourselves, over and over. This is really everything. We're not holding anything back. There's no secret that we're not telling you, and we're using a different technique. And this is it. This is what I've used to create my wealth, and Mark, Ritchie, and we're going to keep using. And um, uh, David Ryan, I do have to say, I love Mark, but I also miss David too. David was a great contributor to this. But he's, with all these principles, same principles he's used for year after year for decades. He's been doing it for about 50 years. I've been doing it for 40. Mark's a relative newcomer, but has 13 years under his belt with this strategy. So it is duplicatable. It is transferable. It is something that you can learn, and you can be at the highest level. And as a matter of fact, because you have the benefit of my knowledge, just like I had the benefit of Bill O'Neill and Nicholas Darvis and Giller and Livermore and all the people that came before me, and Larry Height, who I love, and Stan Weinstein, who's been so gracious to be my friend and to help me. And now you're going to move forward from where we leave off, and you could be much better than me or Mark Ritchie, and move this to another level. Maybe someday you're writing books and you have success, and people are going to be inspired by your path. So no what more to say here, except good luck to everyone. And, with this, you're definitely going to get what you deserve. This is like your input, what you get out of this is directly proportionate to what you put in, and the commitment that you put into it, and the unconditional commitment that you make to it, which you need. You need an unconditional commitment, because you will be challenged. I promise you, you will be challenged. There'll be periods. Matter of fact, if you're new, the worst possible thing that can happen is you get it just right when a bull market starts and everything's easy. That's the worst thing, because then you'll form all kinds of sloppy habits and probably have to have a blow up. The best thing that can happen is you have a real tough time, and you take a lot of losses, and you get whipped all over the place, and you learn right away that risk management is the most important thing. And then you stand a real chance. Not that I'm wishing bad things on you, but luckily I got those lessons when I was relatively pretty poor, and it wasn't so costly. Some people come into this with a lot of money. I've heard, some guys come to the seminar, and they come to me like, I was going to, take a second mortgage on my house and, put $1 million into account and trade. You think that's a good idea? I'm like, oh my God, please don't do this to me. So yeah, if you're just starting out, start small, and learn and build on success. Don't just, go crazy. This is very, very serious business, serious business. On the other, you got guys like Mark Ritchie on the other side of the trade, so just remember that. Always think, what does the guy on the other side of the trade know that I don't know? And with this instance, you know exactly what Mark Ritchie knows, but you don't have the experience yet. So it's going to take time to get to that level. Mark, do you have any parting words?
Sure. Well, I'll just say, obviously, thanks, thanks for having me as a co-host, and thanks everybody's, send a lot of nice compliments my way via Twitter, and appreciate all the good questions and kind words from everybody. I just encourage everybody to take a longer view, spend some time internalizing this stuff, and then just putting it into practice. Small wins lead to big wins, small successes to big successes. And I think you'll be surprised. One of the things Mark said early on that stuck with me is never underestimate small gains compounded over time. The power of compounding is enormous when used with good risk management in your favor. So best of luck having the discipline to follow and implement everything you've learned over the past 5 days together.
Yeah, remember that compounding, as long as you're creating the asymmetric leverage, the power factor is compounding and cutting off the downside portion, mitigating the downside portion of the compounding and getting the upside. That's the real trick. Remember, Bob, any last words?
Obviously, have been through this 13 times with you, Mark, and I think every year does get better and better. Certainly more content, 517 pages worth, and 30 hours worth of time. That is definitely a record for us. So it is really just what I have witnessed with thousands and thousands and thousands of people who have come through the process. It is right in front of you. As I like to say, it's an open book test. There's nothing that was held back here. I know there's a lot of questions. We may not have gotten to all of them, but we did get to hundreds of them. And the questions that may not have been is typically because Mark didn't discuss them. They're not there. All you need to know is there. It's in that book. It's in that manual. It's in Mark's books. And obviously it's now time to put it to use, put it to practice. That is, where private access comes into play. That is exactly how you get to perfectly practice over and over and over, dozens and dozens of times. This is how you're going to become competent and proficient with the methodology, with the knowledge that you just learned. But it is a process, but if you do stick with it, I've seen wealth and riches beyond anyone's imagination when they came and joined or learned from Mark from day one. So it's right in front of you. Go get them. Don't give up.
And if you have any comments, if you've enjoyed it and learned a lot, I'd love to share them on Twitter, please. You can tag me, or love to hear from you on Twitter. And God bless, and health, wealth, and happiness. I wish you lots of health, wealth, and happiness. Happy trading.
Yeah, and we're reading all the comments you guys are typing in here to the chat box. Too many to go through, but complete overwhelming amount of thank yous. And so you are welcome to every one of you. And we're glad we were able to hopefully deliver to you exactly what you were expecting, if not more. And like Mark said, this is what we do this for every year. We love it, but it's now up to you.
We'll leave the room open for a little bit. Let you guys, if you want to leave comments, we'll leave this open for a little while. Thank you. Take care, everyone.
All right. Thank you, Mark and Mark.
Yep. Bye-bye.
Recording stopped.
All right, guys. Thank you for another great conclusion of the 2022 Master Trader Program. And thank you for all the comments, Eden. Thank you. We hope we delivered for you what you were expecting to get, and then some. As Mark said, we do love to see any of your comments that you may share on social media, Twitter, what have you. Just tag Mark at Mark Minervini. And ultimately, as mentioned, don't let the dust settle on those books. Keep at them, keep using them. I know a number of you are alumni, and obviously we certainly appreciate you coming back, because that means you really are getting, exactly what you were getting coming into it, and still thanks, Brandon. You know exactly what you're getting coming back. So hopefully it continues to help reinforce everything that you're learning and helps you get into that level of competency, certainly within much awaited easy dollar environment coming with a new bull market that will follow this bear market when it concludes. That's how it works. You will be in a position to meet and take it full advantage of that opportunity because it is coming. That I can assure you. With my 35 years of trading, a new bull market is coming. No, actually, no, Brian, no plans for an in-person master trader program again at this time. If you do have an interest or have any questions about private access, do send me an email. I'll give you a call. That's the easiest way for me to answer questions for you. You do not need to have Marcus Smith if you are a private access member. One of the features of what we do for private access is we provide for you Mark's watch list. We're essentially doing all the screening for you. Ultimately, you may want to learn how to do that for yourself, but certainly not a requirement from day one. The Marcus Smith promotion is again available. And for those who may already be a Marcus Smith member, I think, like they said, if you just send an email in, they will add an extra month to your plan. If you had any type of promotions or something before, they'll still give you an extra month, but send them the email, not us. GBTC. Is that Bitcoin? Yeah. Excellent to see. Yeah. I know they said something about if you've already had a promotion or something, Lisa, that might be the case. Thanks, Rick. Glad to hear that. Not really able to do that today, Beverly, but I can give you a phone call. Trade station, Andre, but Trading View is great. Plus it's free. Okay, guys, gonna wrap up here and probably go to sleep for about 2 days. Certainly rest my voice. I'm going to sign off, but I'll leave the room open for still a few more moments. And hope to talk with all of you again soon.